Charity, can you hear me? Hello? Hello?
Hello.
Yes, Charity, how are you?
Yes, we can hear you.
Can you get
Fine,
me?
thank you. How are you?
I'm good. I'm sorry for the raise.
No, it's okay. It's understandable.
I thought we would,
Mm.
I thought we would finish tomorrow, but we finished late.
Mm.
But here we
Understandable.
are now. This
Okay.
this girl I think will be joining us. She was also supposed to be joining us, but she told me that she's still in town. I think she will be joining us later.
Vale.
So let's start from where we stopped from. So we are looking at the partnership.
Okay.
The unfortunate part is I cannot write here and we share the notes.
You will?
The problem is I'm not yet able to write.
Mm.
So
Okay.
we'll just be discussing and we shall see what we'll do when we meet physically.
Okay.
So we are talking, we are dealing with the partnership.
Mm.
We simply said that a partnership is where you find you have more than two people coming together and they have agreed to do the business.
Mm.
And we said these people will be guided by what we call an agreement, and this an agreement we call it a partnership deed. So in a partnership deed, we said there will be maybe contents like how the profits will be shared, the allocation of the business. Basically, what will be guiding the partnership as they are running this business, then what are they supposed to be following? We said that binding agreement, we call it a partnership deed. The partnership deed, they may not bring it in these other questions, but in the objectives, they may throw it there. But what are the contents? The following are the contents of a partnership deed, except. So you need to look at them.
Okay.
You see here they are. Then this Partnership Act of 1890, I think this changed. We are now using 20 something, I think of 2010. But where you find that a partnership agreement is there could be some issues that the partnership agreement is not covering. Those issues are covered by what we call a Partnership Act. I think currently we are using the one of 2010.
Okay.
So basically, we are using 2010, but the contents remain, they did not change. So if where the partnership doesn't talk, for example, about the interest on capital, then we assume that there will be no interest paid on capital. We assume there will be no remuneration of partners. That is in case they are what we were treating as the partnership deed. If it is not in the what we are treating as the partnership salary as the partner's salary. So if it is not included in the partnership deed, when we look at the Partnership Act, it says there should be no remuneration. We should not be paying that partnership salary. But this Partnership Act comes in when the issue is not outlined, when the issue is not talked about in the partnership what? In the partnership agreement, which we call the partnership deed.
Okay.
Then from that, we were able to look at the methods of keeping the capital accounts, where we basically said we have fixed capital method and then we have fluctuating capital method. Under fluctuating capital method, we said capital will be capital. We will maintain one account, which we call the capital account, and all the adjustments will be made in the capital agreement.
Account.
Yes, in the capital account. I don't know why I'm using the word agreement so much. And then we said in the fixed, maybe I'm about to get Even marriage, they call it marriage agreement.
Marriage agreement.
They call it what? Then in the fixed method, we said we are maintaining two accounts, the capital account and the current account. We said all the adjustments will be made in the current account. In the capital account, we are only maintaining the balances of capital, and maybe if there is any additional capital, that is what will be in capital's account. The other adjustments, which the adjustments we said we could be having, like interest on capital, interest on drawings, we have the drawings, we have commission or bonus, share of profits, partner's salary. Those will be made in what we call the partner's current accounts. So that is the difference. While we have the fixed capital method, we will be having two accounts, the capital account and then the current account. Where we have fluctuating method, we are only looking at the capital, and all the adjustments will be made in the capital account. Then we also said, this is an illustration, we just basically looking at capital and how to maintain. If you have capital, if it is that, how do you maintain the capital account? So the trick is, which method have they asked? You need to see him, you need to see what he is, the language he's using. He may tell you to use fluctuating, he may tell you to use the fixed capital method.
Okay.
Then the distribution of profit, we said after we have made the net profit from the trading profit, then we go on and prepare what we call the appropriation account. In the appropriation account, we said that is where we are going to include all the adjustments, and the adjustments that we are including here, we said the adjustments will include the interest on capital, interest on drawings, and the partner's salary. The partner, whatever increases our profit, we said that is on the interest on drawings. Then what reduces it is the partner's salary, and then the interest on capital. Those ones will be debited to appropriation account. Then interest on drawings will be credited to the appropriation account. We said after we have done that, then the profit, the figure that we get at the end of the day is what will be shared. That profit is what will be shared, and it will be shared according to the agreed ratios. So we said these ratios will be determined, and they will be clearly indicated in the partnership deed. They will say we have contributed this capital, but at the end of the day, we need to share, and our profit will be shared. Maybe they could be following maybe the capital contributed, they could be following maybe the activeness of the partners. So it will depend. But in every question, in each question that they will say, at least expect that they will give you the profit and loss sharing ratios. If it is not given, then we assume they are sharing equally. He may be silent and he doesn't show that they are sharing maybe profits. If it is not there, we assume that they are sharing equally. I think that is it is outlined by the Partnership Act. So if he doesn't specify, then the assumption is we are assuming that they are sharing the profits and losses in equal ratios. They are sharing equally. That's what we will assume. So after that, after we have gotten that profit, it will be shared in the agreed ratios. We share that, and then we said whatever we debit in our profit or loss in our appropriation account, it will be credited to capital, and then whatever will be credited in our appropriation account, it will be debited to capital account. So it means where we have the interest on capital, if it is interest on capital, what are we going to do? We are going to say interest on capital reduces our profit, so we are debiting our appropriation account. It means in our capital accounts, what are we going to do? We are going to credit our capital account. Where we have interest on drawings, for example, Interest on drawings, we have said they will increase the profit that is going to be shared. So interest on drawings will be credited to appropriation account. In other words, we are increasing the appropriation account, but it will be debited to capital account. Hope that is clear.
Yeah, it is.
So after we have gotten that, then we can share the profit, and the share of profit will also be credited to capital accounts, depending on the method that he will have told you to use. If it is fixed, credit it to capital account. If it is fixed, credit it to current account. If it is fluctuating, then credit it to capital account. And then we said after that, you may find that we are going to, maybe we have been two partners, we want to include in the third partner. We looked at what we call the admission of a new partner.
New pattern.
We said when we are admitting a new partner, what happens? This partner will come in, contribute to the capital. But in contributing the capital, we said once capital is contributed, we are going to credit his capital account and then we debit the bank account. But what happens? Because he's finding us in the business, we have been in the business, we have been enjoying the economies of scale, maybe. We have already established we have already looked for the location, maybe we have the suppliers, maybe at the end of the day, we have our customers, they are already in the place. So this person that is coming in is also going to enjoy these benefits. So he cannot enjoy these benefits and we just let him go just like that. That's how the goodwill will come in. Because we have been in the business for some years, we are saying that this person needs to pay for this goodwill. Because we have been in the business, we are saying let him pay the goodwill. Because we struggled looking for the customers, we struggled looking for the suppliers. Now he comes in when the business is already running. On top of contributing this capital, on top of contributing his capital, we are saying that let's value the goodwill. And we said when we are valuing this goodwill, we could value this goodwill using what we call the revaluation method.
Okay.
You may also throw in this question in objectives, the treatment of goodwill, the factors that may give rise to goodwill. But it's not a common question. But you never know. This man is not predictable. He may throw it there and he gives it like 2 marks or 3. So the sum of the factors could be maybe the location, the nature of the business, maybe efficiency of the management. This person coming in maybe is going to find a good management, market situation, special advantage. So those ones, he may throw it. I've never seen it, but it may come. You never know. Then methods of calculating the goodwill, of course, these ones are not very standard, but this person who has been, these people who have been in the business, they may use these options. Maybe they are looking at the profits they are making, maybe average, they are looking at the sales, maybe they say, but these ones are not common. What he's fond of bringing is this one here. The types of goodwill, the purchased goodwill, the inherent and the negative goodwill. These ones may come in, but the goodwill that we vary in accounting basically is what we call the purchased goodwill. So what we call the purchased goodwill. That one that we are getting, that one which will be recorded in the financial transactions, which arises from financial transactions. In most cases in accounting, it is what we are going to consider. Then inherent negative goodwill, this is where you find like you are making a loss on goodwill, you are realizing value of a business sold as a going concern, but its value is exceeded by its market value is exceeded. It is So you are selling it if you have valued your business, and maybe you are saying your business is worth, let's say 500 million, but when you are selling your business, you are selling it at 300. So that's 200 million is what we are calling the negative goodwill.
We.
So we said when we are recording our goodwill in the books of partnership, we have three methods. This person may bring in the cash. After contributing, he brings in some cash. And this cash, this method, I think I didn't tell you that it is that there are three methods. I think I told you too. We have what we call the premium method. Now the premium method, it is where you find the partner brings in cash in excess of, they could have told this person that you are going to contribute capital of, let's say, 20 million. But they tell him that the cash that, cash that he should bring 25 million. Now that 5 million is what we are calling the premium. It is excess. It is exceeding the capital that this person is supposed to contribute. But this premium method is also not common.
We contribute.
So this premium method is not common. In most cases, you prefer the revaluation method and then the memorandum revaluation method. This premium is simply bringing the cash. They may say that is bringing in this cash, and this cash will simply be shared by the existing partners. This excess 5 million that is bringing in is going to be shared by the old what? By the old partners. So they may decide to record it. The partners may share the cash without any record being raised in the books, or they can say the cash is being used to increase the partners' capital account. They simply credit to the accounts and credit to their capital accounts, but of the old partners, that's why we are saying we are debiting cash and then we credit the old partners' capital accounts. In other words, we are trying to show that this cash, as they are bringing it, he has brought it in cash, but it is increasing the capital accounts of the partners that have been in the business. Or it could be the premium paid by a new partner is withdrawn by the partners and no goodwill is maintained. He has deposited 25 million. So this one is more similar to the first part A. Here the difference is he has deposited the cash in the bank, but this excess 5 has been withdrawn and shared by these existing partners.
Why would they share someone's money?
And because these people have been in the business, what they are sharing is not capital contribution. Remember, we have, for example, said that they have agreed that this partner coming in should contribute capital of 20.
Okay.
He's depositing. They are going to tell him to deposit 25 million. Meaning the extra 5 million is what we are looking at as the goodwill. So at the time of depositing it, remember the capital that is supposed to contribute is 20 million.
Okay.
It means we are crediting his account with 20 million, his capital account with 20 million, and then the excess 5 is going to be credited to the old partner's capital accounts as goodwill. But we debit the bank with 25 million. But here that's that this premium is going to be withdrawn by the partners and no goodwill is maintained in the books of accounts. What happens after they have credited this capital account? Again, they will withdraw this money, the excess 5 million. That would mean that no goodwill would be maintained in the books of accounts because the money was deposited and withdrawn. It is confusing.
Not confusing, only that I'm asking myself, why would they take
And
the
what
5
they-
million to the old partner's account?
we are saying this
Mm.
is goodwill.
Mm.
We have assumed that in the agreement, they have assessed maybe the business and they are saying, if we are to admit a new partner, this new partner needs to make a capital contribution of 20 million.
Okay.
But they will tell this person that
Mm.
because we have been in the business, your capital contribution, your share in the partnership will be equaling to 20 million. But you are going to deposit 25 million. The 5 million is being for goodwill.
Okay, matching.
Then the revaluation method, we said this one, this is where you find the pattern, the goodwill is opened and maintained in the books of. Is this what we said, or we said a different thing? So revaluation, a new partner brings in capital and only agrees to compensate for goodwill. The goodwill is opened and maintained in the books of the business, as this has to appear in the balance sheet as an intangible. Don't you think we did the opposite?
Here we said like the revaluation method eliminates goodwill using the old sharing ratio.
Eliminates, eh?
Yeah.
Then we need to change that, because in the revaluation is where the goodwill is maintained in the books of accounts. Then memorandum of revaluation is where we eliminate.
Then I think we interchange, because here we said in memorandum we maintain.
We interchange them.
So
correct that in memorandum in revaluation method is where we maintain the goodwill. Then memorandum of revaluation, we first recognize it using the old sharing, the old sharing ratios, and then we write it off. In other words, we are not maintaining it in our books of accounts. Please correct that.
Correct it.
So that is good. That is goodwill. So we also said when we are admitting a new partner, we are going to do what we call the revaluation. The revaluation exercise will be done. We said this revaluation can be done when someone is retiring, when we are admitting a new partner. And we said when we are dissolving, we don't call it a revaluation, we actually call it a realization. So this is where the revaluation account comes in. We have been in the business, we are admitting this new person, and we are saying, what should we do? This new person is finding us in the business, but let's revalue. Our assets could have maybe either have reduced in value, or they could have increased in value, depending on what we'll be having by the time this person is coming in. In other words, we are revaluing, trying to put the actual value of the business when this person is joining. So we said that exercise, we are calling it the revaluation, exercise. So when we are revaluing, in most cases we'll be revaluing the assets. We are saying that our assets, so we could have been having it at a cost of maybe 20 million, and we are saying that according to the market value, maybe when we are to value this asset, maybe it is now at 25 million, but in the books we have been having it at 20 million. So when we are
Okay.
establishing its new value, as this person is coming in, or if some other person is retiring, because we said when someone is retiring, then we have to pay him his capital contribution at the end of, at the time when he's retiring.
More when someone is retiring.
So it means we have to establish what is the actual value of the business as per that day. So it means if we have been valuing our assets, we have been valuing them at 20 million, and accordingly we are saying that it should be now at 25 million. There is some profit of 5 million that needs to be recognized. So we said if there is an increase in assets, what are we going to do? We debit the assets, we increase the assets, and then we credit the revaluation account. Because at the end of the day, we said we have to determine whether there was a loss or a gain on disposal, not disposal or revaluation. Again, or loss on revaluation. Was did you look at depreciation?
Depreciation. Yeah, I did.
Okay.
I did. Though what was challenging me was this side of how to calculate the years. When it reaches to accumulated depreciation, how to, there is where they say you depreciate about time apportionment on day of disposal, non-year of disposal, such kind of things. So when it would reach on accumulated depreciation, I would be confused on that part.
Okay.
The years to apportion to what? To the asset. I would do the account of the asset account, I do the one of depreciation, then I do the one of disposal. But accumulated depreciation was still challenging me, counting the time period of when the asset was. You would find something was bought in 2013, then it depreciated in the middle, then it was sold in the month. So that's why I was still finding challenges.
Okay.
Yeah.
Look at that as well. So we are saying if there is an increase in our asset, what are we going to do? Debit the asset, then credit the revaluation.
Revaluation account.
If there is a decrease in assets, credit the assets and then debit the revaluation. So they are also saying that there could be maybe increase in value of assets. Maybe you have been having a payables of 5 million and you are saying that maybe, which is rare. Which is what? But you will see in whatever we are doing double entry. If there is an increase in liabilities, you know liabilities have a credit what? They have a credit balance. So when we increase them, it means their credit is increasing. Then the corresponding entry has to be a debit what? A debit entry. So that would mean we are debiting our revaluation.
Okay.
So we say that at the end of the day, you could either make a revaluation or a revaluation gain or a revaluation loss. So if it is a loss, you will find that the debit side is greater than the credit side.
The credit side.
So that would mean we are debiting our revaluation. We are rather crediting our revaluation because the debit side is greater, and then the corresponding entry has to go to the capital accounts.
Okay.
So if it is also on this, why is the disposal coming in? Does it want us to go to here?
I want you to go to depreciation.
If it is also on revaluation, we are going to credit. We are going to credit our revaluation account, and then we debit the capital account. If it is gain on gain on revaluation, it would mean that the credit side is greater than the debit the debit side. So that would mean, what are we going to do? We are going to debit our revaluation, then we credit our capital or current accounts depending on the method that he would have told us to use.
Yes.
So that is about the revaluation and admission of a new partner. That's when the revaluation exercise comes in.
Okay.
Any question?
No. So far.
Do you have any question on the revaluation? Because we are going to look at realization.
I will read more on it then. If in case I get a challenge, I will ask.
Okay. So we said this partnership could come to an end. Could come to
Yes.
an end. I believe he has something that could make the partnership come to an end. Maybe one of the active partners has died. It could bring the partnership
Abandi shito bagumaho.
and babasaguma huko mpaka tokijubasi. So there are some reasons that may bring the partnership to an end. He may throw in an objective question there, by the way. So you need to look at them. I think you have a book.
Yeah, I do.
You need to look at them. He may surprise us and he brings something there. We need to get him. Whatever he brings, we should be in position to show him that we are not joking subject. So we are saying
It's the third time of doing the paper.
Steve, I can see I have some reasons why the partnership may come to an end. The partnership is no longer profitable, and these people feel they should close it. They should be out of the business. The partners cannot agree between themselves how to operate the partnership. They are disagreements, so they cannot continue with those disagreements. What are they going to do? They are going to say, let's maybe close this partnership, and maybe each one of us goes and does his or her own businesses. Maybe we are saying that there is factors such as ill health or old age may bring about the close of the partnership. They are all becoming too old, but is this point clear?
Yeah, people can age and you feel
They feel they cannot continue.
cannot.
Uh,
Amagezi nigesiba.
uh,
Janga mwena tuminisha mkutesa.
so those
No shanga mwena mtinde shimukutesa mukuzire.
obukadde amagezi baba n'amaanyi.
N'omuntu w'emyaka 89 n'onocu n'amakuru.
Urwo kakiri n'abakarakata. So we are saying that the partnership could come to an end. So here, what is happening when it is coming to an end? The assumption is we are going to sell all the assets that we have been having. So what happens here? We have what we call the realization account. And what happens in the realization account is we transfer all the assets. We transfer them to all the assets and liabilities except bank and cash.
Okay.
Transfer all the assets and liabilities to realization account except cash and bank. So if we are transferring the assets, assets have a debit balance. That's what we said. Assets balance is a debit balance. So when we are transferring them, it means we want to make them be at zero, because at the end of the day we are going to sell them. That's the reason as to why we transfer them to the realization account. So all the assets will be credited and then debited to realization account. So where we are transferring the assets, what are we doing? We are debiting the realization account and then we are crediting the assets account. So where we have, that's what we do when we are transferring the assets. Then when we are transferring the liabilities, you know, liabilities have a credit balance. They have a credit balance. What are we going to do? We are going to credit. We are going to debit the liabilities. Credit our realization account, except cash and bank. Those ones, if we have them, if we have a bank overdraft, we will not touch on it.
Ignore.
We will not. If we have cash balance, those ones we will not touch on them, because transfer whatever assets and liabilities that we have except cash and bank. So what happens after transferring? These assets will be sold. You find is giving you that we sold these assets and this is how much we got. This is how much we realized it. This is how much we realized it. So in this, when we are selling the assets, because when we are transferring them, we debited the realization. When we sell them, we credit to realization, and then the proceeds, the money that we get from the sale of these assets, will be debited to the bank account. We credit the realization and then we debit our bank account. When we have the costs relating to dissolution, when we are dissolving this partnership, maybe we need to consult the lawyers and maybe the advisors on how we are going to dissolve this account, this partnership. If we have those costs, we are going to pay through the bank. We credit the bank and then we debit the realization.
Okay.
Where they are telling us that we have some assets being taken over by some of the partners. It means if they are taking over the assets, what are we going to do? Remember, we had transferred all the assets to realization account. Now it would be like that instead of giving them cash, they are taking some assets. So it would mean we are crediting our realization account and then we debit their capital account. That is where we have the assets being taken over by the partners themselves. That is the transaction that will enter. That is the enter that we will make. Credit the realization, then debit the capital account. So after that, as the same way we looked at the revaluation account, we could make also again on realization. So where we find that what we have gotten from the sale of assets, in other words, if the credit side is greater than the debit side, it would mean that we have made a profit on realization. But where we find that the debit side is greater than the credit side, that would mean that we have made a loss on realization. So that realization gain or loss will be shared in the agreed ratios.
Okay.
So if it is a profit, it will be debited to realization and then credited to their capital account. Be credited to their capital account. If it is a loss, it will be credited to realization and then debited to their capital account. That is the loss or gain on realization. Then after we have done that, you will now realize that we are remaining with capital account and then the bank account. So after doing that, we balance off their capital account. we balance off the capital account.
Account.
When we balance off the capital account, you will find that the money that we have in the bank is enough to clear their capital balances, to be enough to clear their capital balances. You may find that someone has a debit balance. So if it is so, it would mean that this person, though the partnership is dissolving, but he has to bring some money. He has to pay some money to, as the partnership is dissolving, this person has to pay some money to clear the what? Clear his account to zero. Because it would mean the partnership is demanding some money from him. So it could happen, you find that someone has a debit balance. Someone has a debit balance, but these others have a credit balance. Now, this is what comes in. This is what brings us to what we call the Ghana versus Mode. So what happens? The assumption will be if one is insolvent, in other words, he is not in a position to pay his outstanding debt. What happens? We say that the other partners should share that deficit. They should share that deficit in their old capital contribution ratios.
Okay.
So if you, let's assume we have three partners, A, B, and C. Originally, these partners had contributed capital of maybe 20, 30, and 30. That means, let's call it 40, 30, 30. That is 100, let's assume they were millions, 100 millions. This is what they had contributed. And then maybe we discover that C is insolvent. And let's assume his insolvency is maybe 10 millions.
Okay.
It would mean that his insolvency is going to be shared by A and B. But this time, which ratios are they going to use? This time, it is not the capital sharing ratios which are in the agreement. Here we are saying they are going to share according to the original capital contribution ratios. And these ratios now would mean that A contributed 40 millions, B contributed 30 millions. So the sharing ratios would now be 4:2, 4:3.
Oh.
So when they share this, what are we going to do? Of course, he's having the balance on the debit side. His debit side is greater than the credit side. So it would mean we are sharing this. And if we are sharing this, we are debiting A and B. We debit A and B with these ratios that we have gotten. The figures that we have gotten. But using which ratios? The capital share, original capital contribution sharing ratios. You could find they had contributed 40, 30, and 30, but they are saying that the profit sharing ratios may be they are sharing equally. It is possible. But when it comes to this, to Ghana versus Mure, we are saying that they should share according to the original capital contribution ratios. So we share according to the original capital contribution ratios. So that is how it comes in. You find at the end of the day, you have someone having an outstanding balance. That outstanding balance will be shared according to would be shared by the other partners according to their capital, to their original capital contribution threshold. So with this, but he will specify. He will specify. If he doesn't specify, then we assume that this person is going to pay money in the bank, is going to deposit money in the bank. But you will see him somewhere telling you that maybe this was declared bankrupt, maybe he was insolvent, or maybe he tells you that apply the rule under Ghana versus Mure. So when you see him bringing in those words, just know that the deficit will be shared by the existing, by the other partners in the agreed in the original capital contribution ratios.
Okay.
So I saw him talking about this this was August 2017, I think. It's about it. Hope you don't. Do you need these notes or no? You have
Why? Because
Huh?
I have the book.
Hey,
Because I have the book, that's why you're saying I don't need them.
and you
No,
see
I
when they
need.
become many, they will confuse you.
Really? Okay,
But
I think.
let me
But
share.
I have notes. You can share them. I will be reading all sides.
Let me share them. They may be of help also.
Kakimwagaza nimugula ebintu ebitategerekeka mpaka kamu ndabukaawo. You can share them. I don't know if in case you have some videos, because I saw you shared some videos to Carol. If you still have some videos of FA, you can still share with me.
I will. You see these videos, I was downloading them when they were teaching in COVID. It's when I do, some could agree to be downloaded. So those ones that I downloaded, they are the ones that I have now. FA where it was
FA Nira
that was
is very far.
So I don't have them actually.
What you do, maybe you can send me the notes on my email. I don't know if you have it.
I was trying to share through the chat.
I would like that.
Can see pattern present. So you can check through the chat. If you don't get them, then we can use the email option.
For sure.
When you check in the chat, you'll be able to see them.
I'm not seeing them.
You're not seeing them? Okay.
It's fine. Let me send you my email.
Okay, it's fine.
I can send them in my email, maybe.
Okay. So let's look at this question, and then we see how he brings it.
Okay.
I don't think this guy is joining us. He could have been called out.
Rolla. No, you bring me another costume. Do you have that image of cooking stuff? Or take a picture.
So is Fiona. He didn't tell me that you're called Fiona.
Yeah.
Record Fiona.
You throw them out. Yeah, I'm called Fiona, then Charity. Both my names are English names.
Oh,
They
okay.
are funny.
They're not.
I know they are. You won't tell me.
Huh? Okay.
I know they are. You won't tell me because I've been
Oh,
told that so many times.
they are not. They are not.
Having two English names.
Oh, your parents must be educated parents. Mm-hmm.
They are, but
Mm.
still calling me that name wasn't wise.
Oh, it is fine.
Hmm?
It is okay. So, are you in position to see this?
Let's see. Yeah.
Mhm.
Mm,
Hmm?
I can.
What are you saying? Mhm.
Question 2.
Made a yes.
Yeah, Mile Costa and Aileen were in a partnership.
They were in a partnership sharing the ratios. Sharing
Profits and losses in the ratio 2 to 1 to 1.
1 respectively. On 30th
Mm.
June 2017, they decided to dissolve the partnership on the basis of the following statement of financial position as at 30th June 2017. Now, the good thing with these partnership numbers, if it is admission or retirement or dissolution, there is no any other way how we can set these questions apart from the way he has been setting them. What he can change it maybe will be
It is either
admission, dissolution, or retirement. Then if he doesn't bring that, then he will go back to financial statements and then the capital account.
Okay.
Those are the only things he will ever ask on this partnership question.
Admission, revaluation,
Admission,
dissolution.
retirement, dissolution,
Mm.
then financial statements.
Mm.
Eh,
Okay.
Now, when he brings the retirement and admission, then expect the revaluation account.
Okay.
Revaluation account, and then maybe the statement of financial position at the end of the day. Now, the moment he tells you financial statement, that would mean you have to look at that all the adjustments in the capital account. Then when he brings the realization, he will either bring you the realization account, he tells you may be the bank account, and then the capital account, and then if he's bringing realization, he will bring the realization capital account, and then the bank account. Those three, expect them when it is realization. Because we have said at the end of the day, now in a realization, don't expect to find there something like the statement of financial position in the question, no. Because it is coming to an end, and we are saying at the end of the day, we are paying them off their capital contribution, and then the partnership is dissolved.
Okay.
But under revaluation, there you can find he could tell you to even prepare the statement of the new partnership that has come into existence, maybe after admitting a new partner, or after someone has retired. Those ones who remained, you can, because the business is continuing, you can prepare for them the statement of financial position. But under dissolution, it is going to change. We only look at the capital accounts, look at the bank accounts, and then the realization account. Those three is what we expect to find in the dissolution. So in this question, you see how he's bringing it. He's telling you that they have decided to dissolve their partnership. They decided to dissolve their partnership, and they are basing on this statement of financial position. So we have said in this, we expect the realization capital account and then the cash account.
Capital.
In this, he cannot ask any other thing apart from this. But you see, when we look at the additional information, what does he say? He tells us that Mire took over furniture at an agreed price of 15 million. That is what we are talking about, the taking over of assets. Remember, we have already transferred our assets to the realization account. So what does this mean? It means we are going to debit, because she's taking over the furniture, we are going to credit our realization. It will be like we have sold these assets to Mire. So we are crediting our realization account and then we debit our capital account. Our capital account. That is what we are going to do. So the only thing that we need from the assets is simply transferring them from their account to realization account. In most cases, he will not be interested in seeing these accounts. So what you simply need to do, whatever is on the debit side of the assets will be transferred to the debit side of the realization. You can just get it that way. That if they are assets have a debit balance, just transfer them the way they are to the realization account. And what the liabilities have a credit balance, transfer them the way they are to the credit side of the realization account. But we do that for all assets and liabilities except cash and bank. Those ones we don't touch them. Then here where we have the trade receivables paid shilling 30 million in full settlement, and the firm paid off the accounts payable 95 million in full satisfaction of their claim. What did we say? We said we have transferred all the assets and liabilities to our realization account. What does it mean? It means even the trade receivables have been transferred as assets in the realization account. Now, if they are telling us that they have fully paid they have paid 30 million in full settlement, what are we going to recognize? Credit the realization account, then debit our bank. When we look at payables, they are telling us that they paid 95 million in full satisfaction. What does it mean of their claim? We had already transferred them. Just wait. We are saying the firm paid off the accounts payable 95 million in full satisfaction of their claim. We had already transferred them to the realization account, isn't it? So here it would mean that they are appearing on the credit side of our realization account. So it would mean if we are paying them off, what are we going to do? Debit the realization, then credit the bank account. Remember, we have remained with only 3 accounts: the realization, the capital account, then the bank account. Yes. Charity.
Yes, I'm listening.
I thought I'm confusing you.
No.
So we are saying if we are paying these payables, what are we going to do? Debit the realization and then credit the bank, because we had already transferred them to our realization account on the credit side. Then they are telling us that Calista took over inventory and prepayments of 20 million and 15 million respectively. So Prepayments and inventory, they are all assets. It means we had already transferred them to the realization account on the debit side. Now, if she's taking over, if she's taking them over, what are we going to do? Credit to the realization and then debit her bank, her capital account. Credit to realization, then debit her capital account. Realization expenses amounted to 5 million. So if it is this, debit the realization account and then credit the bank account. We are paying it as an expense. Credit the bank and then debit the realization account. Other assets were realized as follows. Remember all the assets we have already transferred them to the realization account. So what are we going to do? Because they are already debited to realization, we are now going to credit to realization and then we debit our bank. Debit our bank. Then Rian was declared bankrupt. Now you see the word is using now. So you will realize that after you have prepared your realization account, you have prepared you have transferred your assets, you have done the realization, you'll find that when you balance off their capital accounts, Rian will be having a debit side. The debit side will be exceeding the credit side of her account, capital account. That is why we are saying that she has been declared bankrupt. She has been declared bankrupt. So if it is this is now when you see here he didn't specify, he didn't tell us that apply the rule in Ghana versus Murray. But the moment he says that this person was bankrupt or insolvent, it means he's not in position to pay what the partnership is demanding from her. So if it is this, what do? We apply the rule in Ghana versus Murray. So we share her deficit. We share her deficit in the original capital contribution ratios. So this would mean that we will share it. We share the deficit in their original contribution ratios, which would now be these two. This is how we are going to share her capital deficit. So it will be shared by Mary and Karista, but in these ratios this time. These ratios here. These two ratios. This is what we are going to use to share her deficit. Are we on the same page? You seem to have muted.
I didn't. Yes, I'm following.
You're following. So we'll share her deficit in these ratios now. So after sharing, you will find that her balance, their balances in the capital account will be the same amount that we'll be having in the bank. So we simply pay them off by simply crediting the bank and then debiting their capital accounts. You'll find they are all balancing too. They are all balancing. So in this number, what do we need to note? The bank account has to balance to 0. The capital accounts also have to balance to 0. They have 0 balances. That is what differentiates it from the realization. Here the capital accounts balance to 0, and then the bank account will also balance to 0. So when that happens, we say that the partnership has been dissolved. It has come to an end. It's no longer in
In the foreseeable future.
Mm.
Yeah, dissolving the agreement.
Okay. So that is the partnership. So will you be in position to try out this number?
Yeah, I will try it.
Try it
Okay.
out and see. The bank account and the capital accounts have to balance too. They have to balance. The debit side will be the debit side and the credit side should be equal. So that is the partnership. If he's to bring it, then those 4 areas, expect them. The financial statements expect to find there. If he has brought the profit or loss, it is rare to bring profit and loss and then he brings the statement of financial position. You will either bring one and he maybe tells you to prepare the capital account. In most cases, the profit and loss and then the capital accounts. But I'm not saying that he cannot bring the two. It is also possible. Can tell you to prepare the statement of profit or loss and then the statement of financial, but that will be too much. That will be too much because if he tells you to prepare the financial statements, then that means you have to prepare the profit or loss, look at the capital account, and then go to statement of profit or the statement of financial position. That work will be too much. In most cases, that's why he tells you to prepare the profit or loss and then the capital accounts, the partner's capital accounts. Because in the capital accounts, what is he interested in seeing? He wants to see, are you in position to bring in these adjustments that you are making in the appropriation account, the interest on capital, the interest on borrowing, the partner's salary, then the share of profits. He wants to see them in the capital accounts. So that is the capital, the financial statements and the capital accounts. If he doesn't bring that, he will either combine the retirement and admission, or he brings one of the two, either admission or retirement. If he doesn't bring that, then he will look at dissolution. In the dissolution, the only thing that he will ever ask there is capital accounts, bank account, and realization account. He may tell you to prepare the necessary ledgers. The necessary ledgers would mean he wants to see how you have transferred these assets to realization account. So in that question, that would mean he wants us to as well prepare these other ledgers. We want us to look at them. So I think if there isn't any other question, when we meet, we can get some other number and we go through it. But if there isn't any question, that would bring us to the end of partnership. That brings us to the end.
We shall do numbers.
We will do the numbers, no problem. I believe by Friday we will be back. I'm coming back on Friday. Holding other factors constant.
It's okay. Can be reading through, then we can be revising through, so that the time we are meeting, I have the concept and we are doing numbers.
Yeah, that's true. We have to do that.
Even I think it can still work even on some other days, that is if you have time, so that the physical face-to-face can be for doing numbers.
It is okay, it's fine. And the good thing with online, we can even do it when you are home.
Yeah, when I'm home, you can still do at any time. I'm very free, no one can stop me.
Okay, we can do that. Icyo nacyayumvike pana
ashobora kuza kusha bene tinazakusha bemere tinakuzakorashi.
Ndacyayombegede nkimanyiisa ekindi kintu. So
Osho mukazi wasiga emyaka inasya notari nakyombekere.
reka kuzaanazaana. Banakyayombegede niba biine emyaka nka 40 okugarura ahaiguru.
So the next topic we.
So what else
Hello?
should we look at? Because it is,
I think
it is still early.
maybe we can go through non-profit
Non-profit making organization.
because I cannot start incomplete records now.
Okay. So let's briefly introduce the what? The non-profit making organizations. What happens to the non-profit making organizations? So rero nariride no kantini but I'm already fine. I'm sorted. Yes, I haven't. I'm actually in class. I have a class.
Habahoki. Tinafanya ibintu bikusirimbuka.
I'm not. Finish it, you'll find you there. That's where I am. Okay, the new building.
I then did you put on the flute? But then so the next child.
Did you guys buy yogurt? Eshindi babaretere ki? Iyo ni mato ino program byona nasa kubiri. Mwenda babaretere ki? Tuwarga kurya ice cream. When say something that you have not yet eaten. Yamara ubu murugero hunasa kushaba nk'ikintu kiri impossible. Nenda bareteje. Before you are very humble, you talk. You're not like on. They can bring you some chocolate.
Chocolate.
Okay.
Snacks. Estar goloso.
Yes.
Snacks.
Crisps.
Snacks.
No, it's snacks. I will take tea.
So, Chad,
Yes.
let's get back to non-profit making organization. So I will
Okay.
say with the non-profit making organizations, you see in all business types that we have been looking at, they are profit oriented. They are purchasing goods, they are selling them. At the end of the day, we expect that
Profits.
they will make profits. Whether sold trade, whether partnership, you see they have a profit element. But what happens to non-profit making organizations, you'll find that their major goal is not profit, is not making the profit. So what happens? How do we account for them then? Now, when we are accounting for this, it is not more different from what we have been doing, only that here are the sources of finance where they get their money, because they are not in the business of purchasing and selling. That is one. They are not offering a profitable service that maybe we are teaching, we are having a school and we are making profit from fees. That is not what they are doing. So what happens? Their sources of finance could either be member subscriptions. You find they are telling you that we have a Rotary Club, and each year maybe you have subscribed, you have 100,000, maybe 150,000. So those ones, we are looking at them as subscriptions. So in non-profit making organizations, this time we will not be having sales. This time we are going to be having what we call the subscriptions. Also, you could find that where they are getting their sources of finance, maybe they have received donations from maybe international outside the countries. They are saying that they are getting the donations. They could also be domestic donations. They are supporting project maybe. So they support. They support
The voice has gone low.
The voice has
gone low over, I don't know. Encourage. Yakariyaza hasi.
Yagendera umukoto.
Yagendera ki?
Yagendera umukoto nosha. Now we are saying under non-profit making organizations. Hello?
Yes.
Or kumpurati. So we are saying that under non-profit making organizations, what will differ will be sources of finance, will be sources of finance basically, because these ones, they get their sources of finance from donations, from membership subscriptions. That is how they basically, that is where they get their finance. What the funds they use to finance their activities, it is from that. So what happens in the in non-profit making organizations, we will not be having the elements like the statement of profit or loss, because we are not profit oriented. So what we have been profit or loss is going to change. What we have been calling the profit or loss under heading profit or loss, the statement of profit or loss. When it comes to non-profit making organizations, we will be calling it the payments and receipts.
Receipts and payments.
and payments when it comes to non-profit making organizations. What we have been calling the cash book. Do you remember the cash book?
Yeah.
What we have been calling the cash book, it is going to change. Sorry. Receipts and payments. What we have been
Receipts and
calling,
payments, they are the infront outflows. So then
what we have been calling the cash book is what will actually be called the receipts and payments.
okay.
Then what we have been calling the profit or loss, it is going to change the name and we'll be calling it incomes and expenditure account. Be calling it the incomes and expenditure account. What we have been calling the profit, what was profit,
And
time will change and we'll be calling it the surplus.
matendo gake kama jihona bia shkai.
What we have been calling profit, this time we are going to call it the surplus. We are going to call it the surplus.
Surplus.
Then what we have been calling the loss, this time we are going to call it a deficit. We'll call it a deficit. Then what else? The statement of financial position will remain the same. Will remain the statement of.
Isn't it the one that has, what is the one that has expenditures and what? The receipt and payments, then income and expenditures.
What we have been.
Yeah, okay. The other one is for cash flow. The other one is for cash flow.
Position remain the statement of financial position.
Mwete munde kanila ndi mu class.
So what we need to know under
Yes.
non-profit making organizations, there are these things what we call subscriptions. Basically subscriptions. Let's look at subscriptions. Now we have said that the major source of finance for non-profit making organizations, one, they have it from subscriptions, but under these subscriptions, we have what we call the ordinary subscriptions. These ones which are paid annually, we call them ordinary subscriptions. Then we also have what we call the life subscriptions. We have what we call life subscriptions.
Subscription.
Under ordinary subscriptions, as we have said, we are paying it annually. We are paying it per annum. We are paying it per
Ordinary.
ordinary, the ones that will be paid.
Ordinary subscription.
Ordinary subscriptions will be paid annually. To be paid annually.
Okay. Ordinary are paid annually.
Then life subscription is where you find you are joining the Bible Society of Uganda and they are telling you that for you to be a lifetime member, you will pay 50 million. Now this 50 million you are pay, it is a one-time pay. You pay it once and you become a member forever. That is what we call the life subscription. Under ordinary subscription, we have said life subscription, under ordinary subscription, you are going to be paying annually. You'll be paying annually. They will tell you that each year you are paying maybe 500,000, or maybe they are telling you that you are paying this much per annum.
Okay.
That is ordinary subscription. But under life subscription, what is going to happen? You are going to pay once and you become a life what? A life member. You become
Member.
a life member. So when that happens, then we need to see how do we treat these ordinary subscriptions and life subscriptions. Now, that is why you find that maybe we are now in 2022, but some people had not yet paid their subscriptions for 2021. Or maybe we are in 2022, but others have paid the subscriptions covering maybe 2023, maybe covering 2023. So what will happen is these ordinary subscriptions, they are resulting. We have what we call subscriptions in arrears and then subscriptions in what? In advance. Subscriptions in arrears and then subscriptions in advance.
Advance.
Now, subscriptions in arrears, these people were supposed to pay in 2021, but they didn't pay. So to us, as a non-profit making organizations, as a non-profit making organization, what are we seeing? We were supposed to have received this money, but we did not receive it. So what we have been having as receivables in the normal profit, in the normal trading business, it is now coming here as subscriptions in arrears. So where we have subscriptions in arrears, we'll be looking at these subscriptions in arrears as our assets.
Okay.
Right? So this thing, subscriptions in advance and then subscriptions in
Arrears.
So what happens will be, if it is subscriptions in arrears, we'll be treating them as assets. And when subscriptions in advance, they have paid early. They were supposed to pay in 2023, but they have paid in 2022. They have paid one year more. We haven't offered any service to these members. They are our members, but we haven't completed that year, but they have given us money in, like we have been having income in advance. But here we are saying that we are calling them subscriptions. So what will happen is, if it is in advance, we are looking at this as a liability. To us, it is a liability. So where we have subscriptions in arrears, we'll be treating them as assets. Where we have subscriptions in advance, remember these two relate to ordinary subscriptions. They relate to ordinary subscriptions. So arrears, we are calling them assets. Advance, we are calling them liabilities. To us, they are liabilities.
Okay.
So when it comes to life subscription, in a life subscription, we are saying here it is paid once. It is paid once for the lifetime. But the question will specify, and they tell you that maybe this life subscription that was paid was covering a period of 20 years. In other words, it is going to be realized over a period of 20 years. What does that mean? It means the way we have been treating depreciation. For example, the way we have been treating depreciation, that we are recognizing a certain expense per annum. The same way will be done when it is right subscription. If they have given us 50 millions and they are telling us that these 50 millions are going to be realized over a period of 20 years, it means each year we are going to recognize a certain percentage, a certain portion of this 50 million, and it is going to be seen as our income for the year. To be seen as the income for the year. So the life subscription, once they pay, of course, once they pay, we credit life subscription and then we debit our bank because we are receiving that cash. But then we have to recognize a portion which will be
repeat that. Sorry, I didn't get that very well.
At the time of payment, this person is paying us 50 million as a life subscription. So we are saying credit the rep subscription account and then debit to the bank. That is at the time of payment. But remember, we have said, we have assumed that maybe this 50 million is the question will specify that it is going to be realized over a period of 20 years. So meaning each year we are supposed to recognize it divided by 20 years, which will be 2.5 million.
But wait, are you using a screen or
Yes.
had you shared the screen? I don't have, because when you started saying figures, I realized maybe you have something on the screen, but I'm not seeing it.
I didn't share the screen.
Yeah. Okay.
So we are saying if we have assumed that the right subscription is for 50 millions, and these 50 millions are going to be recognized over a period of 20 years. Over a period of 20 years, it would mean that we are recognizing 2.5 millions per annum. So this 2.5, it should be the income that should be recognized in our income and expenditure account. Now, when we talk about income and expenditure account, remember we are talking about the profit or loss. But here we are changing the name into income and expenditure.
And expenditure.
So we recognize income of 2.5. That is, remember the accounting concept, accounting period. We are looking at a period of 1 year. So in a period of 1 year, we are saying we are receiving income from rate subscription of 2.5, simply because we are given 50 million, but this 50 million is covering a period of 20 years. So the balance which remains on that 50 million, it will be treated as a long-term liability. As a long-term liability. So this would mean that the rate subscription is divided into the income, which the portion that we are recognizing over a period of over 1 year, and then the remaining balance will be treated as a long-term liability. That is when it comes to rate subscriptions. Ordinary subscriptions, we have said we could have arrears and then in advance. If it is so, in arrears, we are saying those are assets. Subscriptions in advance, we are saying that that is a liability. Then the subscriptions that they pay with during the year, we credit to the subscriptions account and then we debit our cash book, which we are calling the receipts and payments. The receipts and payments. The other source of income we could find it is a non-profit making organization, but it has what we call a side business. It is a club, but it has a canteen. It is Kampala club, but it has a bar. So what will happen? Now, the income that is generated from this side business will also be seen if it is a profit, it will be seen to be as the income, or it will increase the income of the club. But when we are looking at this side business, we look at it the way we are just looking at it at the normal trading business. So if it is a bar, we expect that this bar will be having the sales, will be having the normal expenses. It is the normal business. So the other source of income would be the income from the side business. So this side business, it will be treated normally. To be treated normally, the way we have been treating it under profit or loss. We look at that profit or loss, and then that profit or loss will be treated. If it is a profit, it will increase the income. If it is a loss, then it will reduce the income of the non-profit organization. If I'm not confusing
Yes.
you.
I didn't get in the last statement.
Let me get to the last statement. So we are saying
Ebyaheruka katina bichenga.
we said we are simply looking at sources of what? Of income to the non-profit making organizations. Now we have said non-profit making organizations, their major source of income is subscription. Members, and these members are paying, they are contributing some money annually. They are contributing annually. So when they are contributing annually, we have said that those are ordinary subscriptions. Those are ordinary subscriptions. Subscriptions. And these ordinary subscriptions, we could be paid within the year. So when they are paid within the year, we credit to the subscriptions account, and then we debit our receipts on the payment. If these subscriptions are in arrears, if they are in arrears, we look at them as assets. If they are in advance, we look at them as liabilities. Then we have also said that we have what we call life subscription. Now, under life subscription, we have said here someone pays once. He give us a lump sum, has given us 50 million. This 50 million. The question is to specify and tell you that maybe this 50 million is going to be realized in a period of maybe 10 years. So with that 50 million, we are going to have a portion of income, and the other remaining big portion will be seen as a long-term liability. As a long-term liability. Then we have said, besides that, beside the ordinary subscriptions and life subscriptions, you could find that this non-profit making organization has some side business. It is also contributing to the income of the business. What happens if they are trading? If they have to that side business, we
You account for it.
We account for it normally. We simply create the statement of profit or loss. It's a club, but they have a bar. That bar has the sales, it has the purchases. The normal way we have been trading, it has the expenses relating specifically to the bar.
Okay.
So if it is there, what happens? We will look at it, we treat it the same way we have been treating our normal statement of profit or loss.
Yes.
So if they make a profit, it is going to increase the incomes of the non-profit making organization. If it is a loss, it's going to reduce the income and the incomes of that partnership, of that non-profit making organization.
Okay.
So basically, those are the sources of finance. They are the most confusing part. It is what confuses people. The other things are they are not.
Indeed, it is really confusing. It confuses.
That's what confuses the subscriptions, and then the subscriptions. Basically the subscriptions. Then you also, I think you didn't look at incomplete recording.
Yeah, we haven't.
Because you find there are some expenses that we need to adjust. We will tell you that at the start of the year, maybe we had this balance, and they may not give you the capital. Now, what we have been calling capital the other side, because remember in normal trading, someone would provide capital to the business. But now here we don't call it capital. We should call it the accumulated fund.
The accumulated
We call
fund.
it accumulated fund. So here we don't have capital, we have what we call the accumulated fund. Now, you know, to get capital, we have been saying that we have been using the accounting equation. Do you know the accounting equation?
Yes.
Assets equaling capital plus
Liabilities.
liabilities. So you find that in most cases, in most questions, it tells you to look for the accumulated fund. So we use what we call the statement of affairs. What is the statement of affairs? Statement of affairs is simply the statement of financial position, but at the start of the period.
Okay.
Information may be relating to 1st January 2021. Gives you the assets and liabilities. It means he's telling you to simply use that information, and then you get the accumulated fund, because he may tell you to prepare the statement of financial position. There is no way you prepare the statement of financial position when you don't have capital, when you don't have this accumulated fund. So you need to know what he has given you. So if he gives us that, then we need to prepare the statement of affairs. So that we are in position to determine what was our accumulated fund at the start of the period. Then, it may tell us that at the start of the year, maybe we had some prepaid wages and salaries. And maybe it tells us that at the end of the year, maybe our prepaid salaries had either increased or reduced. So it would mean be interested in what was the expense for the year. That will take us to what we call the control account. Now in the control account, we use that account to get the expense for the period. We look at what we had at the start, look at what we paid for in our receipts and payments, and then we look at what we have at the end of the period.
Okay.
The balancing figure be in position to give us the statement, the expense that was paid within the year.
Yeah, I'm still on.
Okay.
You guys put the fridge off. What's inside? Thank you. It's not that charger. It's another one. The other one. The black one.
I'm going to send you some notes about this.
It's okay, you can share then. I start reading on those two topics.
You read.
Zinena kusiza kwebaka. Ndaba time edunzi. Time yawe nyine okutandika kukora overnight karamba. Well, you share me on my email. I think I'll print them tomorrow. Okay. So that by the time we meet, we'll be doing numbers actually. This time that is remaining, we can do more numbers than I can read that theory and treatment part of things. Then to meeting that correct number, because what happened to me like last reading, I did what? I read more than doing numbers. That's why I think time may come what. Nkakore namba kuonganga zikora mushahaza muherwe. So I didn't use my mind to practice like the length. It may take me to do a paper. So nyonkani so maybe to do kumanya because I enter the paper I knew the things, but the time nkampandika nza nka kashibuku ekyokutamu nenkimanya but nka papaye njikora ngisya rwagati, then I start on suspense imburwa kugimara, like because I was beating time ebintu byonkambiye n'omutwe, but I think I didn't practice a lot. So this time around I think I need to do more numbers than reading. Yes, I will read konka kushanga no practice no kora nka paper and key, but I want to do more papers than this thing of sitting down and doing what? Reading. Remove this soda and put it in the fridge. And clear that table. Mwabagala crisps kale mukiriyaringe. Oh no. Ndebireke ajabiko. Anti yatugambye tumuvanywa. Hello, Precious. 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 Hello.
Yes.
Are you still there?
Yeah, I'm still here. I'm suggesting
Yes.
that we stop here for today.
Oh, thank you so very much.
We'll share the notes.
I,
This recording can be saved to share it. So you get the challenge, you go through the recording. When we meet, we basically be doing the numbers.
yeah, we shall.
So therefore, the now you will use it for numbers. By the time we finish the math, doing the numbers, you have given us a good picture.
Caliban.
Thank
Thank you so much for today's class. I appreciate it.